Now, the central bank has eased its monetary policy amid the COVID-19 pandemic. The widely expected move effectively weakens the Singapore dollar. As Brandon Tenoto reports, it's the most aggressive move by the MAS since the 2009 financial crisis.
Weakening the Singapore dollar will be an upside for a trade-reliant and open economy like Singapore.
When it comes to the export competitiveness as well, today's easing would help bring down the currency slightly, which may help with some of the businesses that are trying to export.
Economists say the latest policy shift won't have any immediate impact on the daily lives of Singaporeans, but the central bank's deflation forecast could.
Oil prices are going to stay low for quite a prolonged period, and domestically, with lower consumer sentiments as well as a weaker labour market, you may see a decline in demand, which would result to a fall in prices. So I think inflationary pressures will not exist in 2020. We will likely see prices of most of goods and services come down because of the reduction in demand.
Looking ahead, economists expect MAS to stand pat at its next policy review in October.
The October meeting will be no move, nothing changes. The reason I'm saying that is because if the MAS does nothing in October, it probably means that we are probably beginning to find a bottom and beginning to recover. So MAS leaves policy as it is to allow for that recovery to take shape going into 2021. If I'm wrong and the MAS needs to do more, then that's not going to be good news for the economy.
Singapore also lowered its growth forecast for 2020 to between -4% and -1%. That outlook is worse than the earlier estimate of between -0.5% and 1.5%. To this end, economists expect another fiscal package if a global recession persists. In fact, Deputy Prime Minister and Finance Minister Heng Swee Keat has said that with the uncertainty remaining in the horizon, the government will monitor the situation closely and when necessary, it will be prepared to propose further draws on past reserves. The resilience budget will draw $17 billion from past reserves. That's more than triple from the last time Singapore dipped into its coffers during the global financial crisis.